Morning.
Good morning, James.
Well, thanks very much for doing this. Say it's a bit different to what we normally do, but there's no real structure to this. But I think what we ought to do. I know you've got a few slides here, but let's just set the scene with this one about inflation. So, as we know, inflation rocketing ahead has caught a lot of people by surprise and maybe caused a huge kind of shift in the market. So within Cannacord, what sort of things are you doing in response to this?
Yeah, it's a good question. I think it is worth setting the scene just for a couple of minutes, and then we'll talk about exactly what we're up to. So I think the first thing to say is that the economic data is actually quite mixed. This is probably why we're not seeing central banks go too hard. So we're clearly seeing a slowdown in activity. And if you wouldn't mind going to what I call slide 5, the economic activity slide, and this basically just highlights ISM manufacturing PMI data. You can clearly see it's highly cyclical, and we're going into a broad slowdown on that side of the market. But more recently, we've had pretty decent service data come out. The ISM services PMI data was more robust than expected by the market, and that sort of helped in terms of activity and investor sentiment. The other side of this, of course, is outside of kind of the PMI data, we're seeing that whilst short-term inflation data is clearly negative, the long-term inflation expectations remain quite anchored. And there's a slide in there on inflation expectations as well, James, what I call slide 4. You can see that they remain well anchored. And in fact, in the UK, that the forward expectations have come down somewhat as well. So there's mixed bags there in terms of the economic data. And then, of course, we have to consider the earnings data as well. I haven't got a slide to this, but just to say that, big tech data has been pretty positive in the US in terms of relative to expectations. The earnings haven't been terrible. A lot of bad news has been in the prices. And when you consider things like the earnings surprise index from Citi or the economic surprise index, they're in firmly negative territory, which implies that lots of positive data or slightly less negative data can turn sentiment very quickly. So we're in this kind of strange middle ground where we're clearly entering a slowdown, but the labour market's quite strong, long-term expectations are okay, and valuations now across markets are pretty good. So we've got a US valuation slide in there on slide 8, which is this is a simple forward PE ratio of the S&P. We've had a slight recovery, and we've reached the upper bound there, 17.5 times on the latest count, and only marginally really above the long-term average, which is that orange, the lower side of the average of the orange line. So we're seeing all sorts of things come together. And so what it's led us to do is, be quite balanced in our approach. I think we've made an argument for both long and short duration assets in a portfolio. We feel there is a place for both of those types of assets right now. Clearly long duration assets, the quality growth, the more aggressive growth assets of this world have sold off meaningfully across the board. You've seen it in the investment trust space very prominently. And there's a lot of discounts to go for as well. So we've kind of recognized that and tried to be as balanced as possible. And I'll just stop there, James. Hopefully that's
no, fair enough.
Yeah.
So we settle this US page first. Obviously, there's a risk here that earnings are going to sort of fall if we have a recession, and that will affect PEs. And also, I suppose you might argue that if people sentiment does get that bad, that we could see touchdowns to the lows that we saw here. So there could be quite a long way to fall. But within, just say like North America, do you hold any kind of specific North American funds, or do you tend to do it through global funds?
Yeah, so we do allocate regionally as a business. We do have specific North American funds, open-ended and closed-ended as well. But in our models, we're mostly open-ended, and we're regionally allocated. Yeah.
Okay. And then within that, do you have a sort of preference for anything particular? I mean, what's your view, for example, of the JP Morgan American Fund?
Yeah. So, are you talking about the investment trust, James?
Well, I don't know which one you hold, but
yeah. So I mean, we do have Jam on the list. We
okay.
like it. We do like it very much. We do consider it a core holding, actually, and it's one that we have over the last few years been adding to. It's quite a compelling mandate, actually, JP Morgan American, because they have quite a good valuation discipline. So buying quality companies with that valuation discipline. And this is what we're seeing more and more, is actually these sort of GARPy type mandates, a growth at a reasonable price, starting to come into the spotlight a bit more, because as we go into an earnings slowdown, you want to be invested in resilient companies and buy those companies at a reasonable price. And that empirically, that's a very good way to play a slowdown. So, value has its place, but if it's inherently a cyclical type investment, which a lot of value tends to be these days because of the way that the valuation methodology works, cyclicals will go into an earnings slowdown a lot quicker and sharper than a more defensive or quality type stock. You're thinking of your staples and utilities and healthcare, etc. So those sectors have become more favorable with investors recently.
What about large cap versus small cap? Because we have seen a lot of funds in areas where small caps have been underperforming now for a while. Do they?
Yeah, absolutely. I mean, we like small cap. We think it's a brilliant way to add alpha, certainly within the UK and the US historically. We think that, if you can find managers who have a tried and tested process, and you can buy them at a relatively cheaper level today, then we think that's a good way to play. If you look at the UK, BlackRock UK smaller companies, in the US, JP Morgan US smaller companies, Just those two are very, very compelling mandates, long-term track records, very, very high quality teams with robust processes. They've been sold down significantly, and we think that these are pretty good entry points. If you've got the risk tolerance and you've got the time frame, I think they're the two key factors. If you're thinking 12 months out, I think we're still in for a choppy ride with small caps, just purely because, as you say, there is scope for earnings to come down a bit more as consumers get squeezed more on inflation. So, and you've seen the savings ratios come down as well, and all that sort of points to discretionary spend being squeezed. And so small caps inherently are more sensitive to that kind of data. So we think that your time frame is absolutely critical. If you're thinking 5 years plus from here, even 3 years plus from here, we think these are good entry points for small caps. But shorter time frames than that, you're going to be, well, nobody knows. It's anyone's guess, really.
On a kind of regional basis, do you have sort of like a favoured countries or favoured regions?
Yeah, so we're marginally overweight Japan, which we think is quite an interesting one at the moment. Japan is a country that historically was always considered a sort of deep value trade. Lots of people called it wrong. You had the issues with the yen. What you made on the market, you lost on the currency, and it's been tarnished with a lot of bad brushes. But really, since Abenomics, so going back to 2012. We've seen a huge amount of change in Japan, and it's mostly to do with corporate governance. A lot of the problems in Japanese companies were to do with things like cross shareholdings, where two big conglomerates would invest in each other and try and sort of control the narrative, or where they have listed subsidiaries. And not many other countries actually do this sort of thing. Excuse me. And that's starting to change. Corporate mentality, corporate governance, issuing dividends to shareholders, that wasn't a thing that was widely done in Japan, a couple of decades ago, but now it's a huge part of the sort of narrative, the story going forward. So we like Japan. We think that it's a very interesting market, and we're seeing quite strong earnings coming through in that market, attractive valuations as well, and it's one that we think we the story hasn't finished. That the Abenomics story has started really to pick up the last couple of years. It's a delayed reaction almost, but on the back of COVID, you're starting to see a reopening as well. I think it could be a very interesting place to invest for the next coming couple of years.
So one of the things that we've picked up on before is the big difference between the kind of funds investing in future Japan, if you like, things like JP Morgan Japanese and Schroeder Japan, and the funds that are investing to unlock the value in maybe a lot of sort of old Japan type companies, things like AVI Japan and opportunities in Nippon Active Value. Do you have a sort of favourite between those two, or do you actually hold both?
A great question, and yeah, we do have a couple of strategies, that focus on both of those elements. JP Morgan Japanese is a very interesting and topical point. They're a quintessential, long duration, fairly aggressive growth way of playing Japan, and they're very concentrated sectorally. Healthcare and technology and all that good stuff. But you do have other elements of Japan as well, as you've pointed out, where they're tapping into that change and they're trying to find catalysts for change. We have both of those mandates. We think they both can work together. But what we're starting to see is, even in funds like JP Morgan, you're seeing change in those companies as well, additional change where corporate governance policies are coming through to favour shareholders. And that's even unleashing share price appreciation in those sorts of companies as well. So it's across the board really, and I think those strategies are going to start to become indistinguishable as all these companies move towards becoming better companies, better corporate stewards of capital, etc.
The question here about whether there are lessons that we can learn from Japan's economy because of this issue of aging populations that they've been dealing with for a while, but are an issue in lots of places in Europe, for example. Is that something, that sort of theme that you're looking at within your investments?
Absolutely. It is a crucial question we think about a lot. One of the key ways we're playing the aging population theme and labour shortages ultimately is what it means is through automation. And we play this in our ESG strategies and our core models as well. We think robotics and automation is the answer to an aging population. And clearly that's what Japan have done over the last couple of decades. And I think it's the way forward for other economies. And actually, COVID has also put that into perspective. We can't depend on international supply chains, or if there's labour shortages due to COVID, what do you do? What's the answer? Well, the answer is actually automation. And so we're seeing that come through quicker than we'd expected, really. And that's a key way we would recommend playing that.
Okay. If we stay some regional theme for a bit, what's your kind of view on China at the moment?
Yeah, we have there's different comments, but ultimately we don't invest. So the facts first, we don't invest directly into China in our core models, but we do recognize, it's an incredible economy, lots of interesting opportunities there, and we prefer to play it through kind of Asian or emerging market funds, or allow the managers to allocate as necessary. We do have a number of standalone Chinese investments if people have that appetite and risk tolerance, and then we do have a few that we recommend on panel. We've got a couple in the investment trust space. We like the Fidelity China Special Sits, the JP Morgan China Growth and Income. So there are ways that we believe you can play this in a very structured and quality way. So you've got the kind of structure of those big houses around those strategies. But the one thing nobody will ever know is how far regulation can go in terms of its disruption. And we've seen a lot of those challenges come through. So we don't invest as a standalone. we do recognise there are issues, but we also know, it's the second biggest economy in the world on certain metrics, and it's going to power a lot of the growth of the future. And made in China is a theme. The government have talked about this, turning domestically, becoming more high tech and automated. And let's not forget, China have got a population problem too. They've got an aging population, and the median projection for Chinese population growth is decline. And by the end of the century, they could lose about 40% of their population. That's about 80 years away. It's not long. And so China have got to radically change the way they do things. And we think with that will come opportunity.
Okay. And actually, just stepping back a bit, looks like a big picture. How do you actually asset allocate for portfolios? Do you have a sort of benchmark in mind, like MSCI World or something, and then look at things relative to that, or?
Yeah, so we have several ways that we do this. So we have an internal benchmark. We look at pretty much it's 70% the FTSE All World ex UK, and then 30% thereabouts the FTSE UK index, the FTSE All Share. And the reason for that is obviously we've got a home bias. It's the way that our models are structured. It's the way that the peer group also look at their lens as well, the ARC, PCI, peer group indices. So that's kind of the starting point, and then we evaluate our kind of over and underweights relative to that, and where we want to be on a regional perspective. But from a wider, taking a step back, so I'm talking about the equities. So if you're thinking about equities versus fixed income, there's another set of indices which we reference, which includes the fixed income element. And we also have an alternatives bucket as well. So we truly are multi-asset in our approach. We first of all have to gauge the relative opportunities in risk. That's where we start. So we're always looking at whether we want to be over or underweight equities relative to other areas, because that makes most sense. It's the largest part of the portfolios. Typically, it's also where you take the active risk with our investors' capital. And so we're always trying to be aware of where we want to be in regards to equities.
Okay. There's a question just popped up here about ESGs. It's specifically referring to China, but just maybe can you explain how you apply that across the board with what you do?
How we apply ESG
yeah.
into our framework? Yeah, so I mean, the key for us, so there's a separate ESG mandate and team, and they've got a very specific idea of how they manage money, and I'm on that committee as well. But we look at things from an impact perspective, how strategies are helping both the world and people. It's a very specific mandate. But taking a step back, how do we look at all of our mandates through an ESG lens? The most important thing for us is engagement. We have to make sure that managers are engaging with their companies and engaging for the better. So we like to look at managers' voting track records, assess how they actually work with their companies, if there's any sort of problems. And a lot of managers, especially in the UK and in the US, they've been engaging with their companies for years. Governance is not really an issue. So it's more about how they're impacting stakeholders, the workers and the environment and things like that. So really for us, the most important thing is to ensure managers are engaging properly and efficiently, and they've got a track record of doing so. And that's the key way for us to do it. We don't specifically say that every single manager must have an ethical mindset or an impact mindset, but we need to ensure it's integrated in their investment process.
Okay, thank you. So now let's just maybe think about Montanari European, because it's one of the ones we always cite with Europe and ESG. But Europe then, obviously, with what's going on in Ukraine and with what's going on with gas supplies, Europe's got a lot of sort of challenges ahead of it. Is that an area that you're exposed to much?
Yeah, it's a great question. So we play Europe. We've got we've got some of our mandates have European exposure in the global space, of course, and so we don't have a direct allocation to Europe currently, but we appreciate we have some indirect exposure. That's the first thing to say. We do like Europe as a place to invest. Many of our investment managers do have European allocations, but it is on a bottom-up basis. I think the important thing to say, and something Montanaro would I'm sure also talk about, is the exposure of the underlying revenues of these companies. They're often not just based in Europe. If you're investing in a high quality company in Europe, you've probably got global revenues. So, and I think this is probably some of the kind of fallacy that the investment community have made historically, where we look at things on a listed basis and not necessarily on an operational basis. So we think there's plenty of good companies in Europe. It's about the bottom up. It's about making sure those companies have a global revenue exposure, making sure they're well run and they're not exposed to kind of the current issues, as you've mentioned, the unfortunate situation in Ukraine. So it's all about balancing those things. So we're very bottom up, quite open-minded about Europe, and we do acknowledge that Europe is more than just kind of the sum of its country-specific parts.
One of the things, I mean, that fund has struggled this year, but in common with a lot of other funds that say they focus on growth and quality. And you'd think that those be the sorts of things that you'd want to be invested in a kind of recessionary environment where the economy is getting more difficult. You need the pricing power, that sort of thing. Why do you think that those funds aren't working so well at the moment?
Yeah, it's something that we rack our brains a lot about. I mean, the Montanaro fund is one of the best performing in that space over 5 years. It's got a very stellar 3-year track record, and more recently it's been sold off. I think this is partly the narrative. It's partly the result of the increased allocation away from regional mandates and towards global mandates. We've seen that in the Investment Association flow data. Investors have increasingly favored multinational mandates and global mandates over regional over the past few years. And where something has a small cap bias, it's just been sold. They're often the first to go in kind of a crisis situation, irrespective of quality. We've seen that Montanaro is on sort of a double-digit discount right now as well. So a lot of this is sentiment driven, and I think we just need to be aware of that. It's not, I suppose, in a historic context, it's not too unusual. But you're right. This is a time where quality growth should come into vogue, and we're starting to see that in the earnings, at least, if not the share prices. We're seeing the earnings are much more resilient than the market had feared, and I suspect that we'll start to see some inflection points. This is just my opinion. It's not necessarily the opinion of Cannacord's Asset Allocation Committee, but my personal opinion on looking at investment trusts. I think we will start to see people come back to these sorts of mandates in the near term as the earnings come to bear fruit.
Do you have any sort of allocation policy between investment companies and open-ended funds in different scenarios, economic scenarios?
Do you mean, if we're anticipating a downturn, we would probably avoid investment trusts? Do you think something
like that? Yeah.
Okay. Yeah. I mean, we don't have a specific mandate that sort of recognizes that, but investment trusts historically, we know from an industry perspective, they're the first things that people tend to get rid of if there's a risk-off environment. The more riskier ones, especially. Because even some of the multi-asset and alternative investment trust vehicles often have near-term equity correlation, even though the underlying assets have none of that exposure, or you look at the likes of RIT Capital or Personal Assets Trusts, etc. Those alternative vehicles often bear more equity correlation in the short term than you'd want, even though the underlying is pretty robust. And I think that's part of it. It's that sort of investor mentality around the fact that they're listed vehicles. We have to be mindful of liquidity in a stressed environment, and so they're often the first thing to go out of portfolios across the industry. Not just referring to Cannacord here, but across the industry, you can see that. And if you speak to the teams, the sales guys or the actual members of the board, you'll see that often their shareholder register changes around a lot during these sort of stress periods of time, especially with sort of platform companies where you see the big platforms on shareholder registers. You know it's going to be a volatile few months when you go into a downturn.
I mean, do you think we've had the big sell-off now? We've seen discounts widen. Obviously, geared funds have been geared into the fall. Do you think maybe now it's time to go bargain hunting in investment company land?
Yeah, I think once again it comes back to your time frame. If you are genuinely long term from here, we're talking more than 3 years, 5 years ideally. We can envisage that you would potentially make a lot of return on certain investment trusts here, and that's the key. It's the time frame. So, has volatility gone away? Probably not. We're entering a cyclical slowdown, but we don't know where that ends up. We know that the Fed want to keep increasing rates, so we hope they don't break something, but you never know. So there are risks out there, but a lot of those risks have been priced in. That's why we've had the big move. So I guess it's a case of set your time frame, set your risk tolerance, and you could probably start to allocate to some of your favored mandates, especially where you've got double-digit discounts. We were looking at Scottish Mortgage, for example. The discount it reached was relative to 2008. So it's that sort of sell-off that had occurred already. The benefit, I suppose, that the good side of the data is that there's signs that inflation is just starting to plateau a bit, albeit at a very high level. We're not making any comments on how quickly that comes down, but if you look at year-on-year comparisons, some managers we've spoken to do believe that's going to start coming down. Even next year and the year after, we'll probably settle slightly higher levels than we're used to historically. But there are lots of signs that we've plateaued, so that's going to be potentially good for markets. But it's just about how deep this slowdown goes. We just have to keep an eye on that.
Does your portfolio change much in this kind of environment?
My personal portfolio, or
well, the normal with it just turnover go up within the firm.
The core portfolio that we sort of, if I reference the kind of core model, we've ensured again that we've had balance in the portfolio. We have some value names in there. We've increased a bit of quality in there as well to ensure that we're not overly exposed to one particular star right now. So we've gone much more balanced. We have got long duration assets in there. We've got some multi-cap funds that have significant small and mid-cap exposures because we think they will come back in time, certainly as the earnings come through. And so we've got a whole host of things. And the key change was ensuring that we were balanced between growth and value. But I don't think that's necessarily an unusual comment to make.
If you're an income investor, is there any way of inflation proofing your income? Investment
trusts have historically helped with this. We can see, obviously it's called the smoothing effect, but when investment trusts retain capital, as you know, on their balance sheets, they can smooth out income in more difficult years. So a number of investment trusts, specifically UK equity investment trusts, have done this throughout COVID. City of London was a very prominent example. It maintained, or actually grew its dividend through COVID, and again is on track to have another good year from a dividend perspective. So you can protect income more with investment trusts because of that ability to retain capital. You can also, there's ways that you can do it through things like inflation-linked assets as well. So real assets are your friend in a period of inflation, where you want to inflation-proof your income. Real assets are the way to go. You've seen with the infrastructure investment trusts. You've seen it with kind of multi-asset trusts as well. They often have inflation-linked contracts with their end companies or governments, whoever the customers are, and those links come through. And you've seen it in the utilities as well, utility space, and we certainly felt that at home, I'm sure. And in the energy market, you've seen that come through. So there are ways to do it at the margin. We would say that, open-ended funds kind of struggle to do that through COVID. You saw immense drops in terms of the dividend year-on-year growth values, that they've come back largely now, but it takes time. Whereas investment trusts, you do get that buffer.
You set much store by things like the dividend hero lists.
Yeah, I think, to be completely frank and honest, if investment trusts aren't dividend heroes when they're an income strategy, I'd say that's probably where they're concerned, because pretty much all of them have the ability to retain capital. They have the ability to smooth earnings, and if they run an appropriate mandate with consistency of income generation, they should get that dividend hero status. I mean, yeah, I applaud the ones who have got multi-decades behind them, and City, of course, I think it's over 50 years, and yeah, that's an incredible achievement. But a lot more, have got that status and have aspired to get that status. And so, yeah, I don't think we can necessarily select the investment with that as a prominent feature. It's a nice thing to have, but if you haven't got it, we just have to assess the reasons why, and whether we accept those reasons as well.
Sure. Okay. Question here is, so if a manager's got both an investment trust and an open-ended fund with the same strategy, how do you decide which one to buy?
The easy answer, James, is the investment trust version on a discount. I mean, that's obviously the kind of prominent answer. And if it is on a discount, we typically would allocate there. Investment managers have been known to switch over to the trust where we like the manager and strategy. The second question would be about liquidity. From an institutional perspective and the size that we are at Cannacord, we have to be very, very cognizant of liquidity and daily trading volumes specifically. Sometimes it can take a very long time to get in and out of a trust at the sort of volumes that we sometimes require. So it's really the discount opportunity and liquidity.
Do you ever buy new issues?
Yeah, we do. And sometimes brokers will work with institutions to get a good price on a new issue, and so we often have access to these prices because we're buying at scale. And so it's sometimes beneficial for institutions to buy new issues, and we work with various boards to see what's coming up. And whether we can participate, etc. So yeah, new issues have their place. We're probably more favourable to new issues than IPOs, for example. IPOs, we often like people to generate a track record and assess the liquidity before we invest.
Okay, that makes sense. We're going back to the macro again. So do you have a sense for whether the UK is in for a sort of rougher time than maybe like the US or Europe? And if you do, have you sort of adjusted the portfolio ratings accordingly?
Yeah, we have over the past few years, we have lowered our exposure to the UK. This really started before COVID. There were a lot of political issues that came out of Brexit, and I think global asset allocators in general left the UK behind. But you have to understand, it's such a small part of global indices that you can totally understand why they would do that. And it's not a place that has a particularly how would you say it, invigorating or exhilarating index. The FTSE 100, I'm sure, as you well know, and the listeners are well aware of, that the 100 has a lot of old economy businesses in there, lots of commodities exposure. It's got the highest commodities exposure in the world as an index, and it's why it's been particularly difficult to outperform it this year. it's an index that doesn't particularly inspire. There are some incredible companies on that index, and that's why we selectively buy them. But the kind of impressive area of the UK for us is down the cap scale. So we think that the 250 is a very good index. There's a lot more sector diversity going on there. You've got some technology, and UK small caps are particularly outstanding as well over the long term. So there are certain areas of the UK that we like. That's why we tend to have a bit of a SMID bias in the UK, and pretty much all of the managers do anyway. So you'd be hard pressed to find purely large cap UK managers. So that's from a market perspective. But economically, you're asking about kind of, will we be impacted more here in the UK? Traditionally, we sort of have been, and that's because we're less dynamic, I suppose, than the US in terms of the way we're structured, regulations, how we approach things, and the way we're set up in terms of the free market, etc. The US is a very, very dynamic economy, tends to rebound a lot quicker than others in the West. But it's ultimately going to come down to that the consumer strength, because that's what drives our economy in the UK. Consumer savings, consumer earnings, they'll be the key metrics we assess going forward. We hope the slowdown is shallow. The Bank of England is being quite tepid in how they raise the rates to try and navigate that. So we'll see what happens. But we're generally not as resilient or dynamic as the US, but very few economies are.
Yeah. Okay. Fair enough. I know you're really what about listed equities, but one of the things that we've seen people like the Baillie Giffords of this world argue is that more and more of the opportunities are in the unlisted market, and that's why they've been putting more of their funds into private stocks. Is that something that you're comfortable with, or would you prefer that the listed equity managers stuck to listed equities?
Yeah, so just on the facts, we do invest with Baillie Gifford. We have a number of their investment trusts on panel, and we have historically been comfortable with their private equity exposure. They recently unveiled their methodology on their website and talked about it in great detail. They have quite a concise and robust methodology on how they do it, probably more so than many of their peers, and they probably have to be because of the size that it is. What we would say is that we have to be comfortable with the reasons that they may increase that exposure over time. Scottish Mortgages has got a 30% limitation currently. In the future, they may go higher, but we need to be completely on board with why they would do that, and that's up for discussion. But yeah, are we comfortable with that sort of exposure? Yes, definitely in a listed vehicle. We're not comfortable in an open-ended space, and most people have tended to shy away from it since Woodford. And so that was a good turning point for those sorts of assets and exposure in the marketplace. We do agree that private equity has got a lot more opportunity in it today because companies basically stay private for longer. That's the point of these managers, and we do agree that is something that has happened. If you look at the time it takes to IPO now, it's a lot longer, and the number of stocks coming to market has decreased in terms of averages over time. Certainly the case in the UK and the US to an extent as well. You've seen that play out. But as with all of these sorts of trends, it's about whether they kind of plateau out at some point or reverse course, because what we saw in COVID, again, was that being listed was massively helpful to your business model, because it allowed you to get access to the full capital markets to raise that capital when you most needed it. And we saw some private equity companies struggle during that time period to raise money. So we think there are, the benefits will be shown and borne out of listed markets as well in the future.
There's loads more questions. We could go on for ages, but I think we've given it sort of 5 to 12. We should probably wrap it up there. So thanks very much, Kamal. I think it's really, really interesting. Sort of, we've gone all the way around the world and discussed all sorts of businesses. Suppose if we didn't get to your question, there's a few there. Somebody else looking for a job again. But thanks very much, and we will be back next week. So we'll. There's some more charts here, but I think we've seen most of those things before. There we go. Good. So we'll talk to Kamal again maybe in the future. So we'll be back next week talking to the manager of Henderson High Income, who's David Smith. And then, as I say, we've got a full lineup. I think we've got more beyond the 16th of September. And we have been listening to, we've had a few suggestions in, so we've been listening to you, and we're trying to get some of more of those on. So I hope you have a good week, and we will be back next week with David Smith. Thanks very much. Bye-bye.